Good day, my students. Welcome to you all to this lecture as part of investment analysis and portfolio management. Now, we've already gone through a dozen lectures, and I believe so that by now you would have developed a certain amount of interest in this particular subject. Now, this indeed is a very exciting subject, like I have mentioned before. And very briefly, in the previous lecture, I had told you a number of things about fundamental analysis and the statements of retained earnings, cash flows, and balance sheet. Now, fundamental analysis is not only about crunching numbers in the current regime, it is also about analyzing the previous past history of a common share and its relationship with other companies in the industry. We talked about qualitative analysis, and we talked about quantitative analysis. We talked about the theoretical aspect of analysis and the empirical nature of research in fundamental analysis. We did talk about ratios and how you could find out about things related to a company in the balance sheets. We had previously also talked about technical analysis, but currently we'll be talking again about fundamental analysis, carrying forward from our previous lecture. Once again, fundamental analysis is about looking at the finer details and finding out finer patterns and looking at between the lines in a balance sheet, looking at positive cash flow statements, looking at all the reserves that a company has, the retained earnings, its ability to withstand problems through the reserves that have been built up over a number of years of operations. And this is what we do while we're talking about value investments. In one of our previous lectures, we had talked about the difference or the comparisons between value approach and growth approach. This is all about value approach. This is all about companies with a history. This is all about companies with a track record of paying out dividends, with a track record of growth in earnings. So we talked in detail about different ratios. We talked about liquidity ratios. We talked about leverage ratios. We talked about profitability ratios. We talked about investments in interest coverage ratios and debt coverage ratios. We talked all this in our previous lecture. Now, when we talked about all these things, we did talk about things that were to be discussed in detail in other lectures as well. So, we need to understand what fundamental analysis is, and it was crunching and analyzing numbers from the financial statements. And when this methodology is used in conjunction with other methods of quantitative analysis, can produce excellent results. So we need to look at the other side and consider tangible and measurable factors along with general or qualitative factors. That was briefly what fundamental analysis told us all about by looking at the analytical aspect of common stock. We would not bother about the preferred stock because that's more like a bond. We're more keen on the common stock and investments in common stock. So, I told you ratio analysis is not just about comparing different numbers. It was also about numbers not only from the balance sheet, or from the cash flow statements or from the statement of retained earnings, it's comparing the number with previous years. It's comparing numbers with similar companies. It's comparing numbers with the industry norms, and it's comparing numbers with the economy in general. Now, ratios look at relationships between individual values and relate them to how a company has performed in the past and how it might perform in the future. That is what actually ratio analysis is all about. Not just focused on the cash flows, not just focused on the retained earnings, and not just focused on the balance sheet. For example, we can look at current assets alone, but they don't tell us much. There's no point looking at current assets, but when we divide it by current liabilities, then a whole new picture evolves, and we are able to determine whether a company has enough money to cover short-term debts. So if you look at in isolation at one aspect of the balance sheet, we might not know much about it. If we look at a bigger picture, we'll have a better position of what the company holds in future for its stakeholders. So current assets and current liabilities go together, and only a positive outcome of current assets minus current liabilities will give us a go-ahead signal to invest in such a company. So, a ratio analysis of a balance sheet can identify potential liquidity problems as well. It can also signify a company's inability to meet its financial obligations. Then again, an investor can also spot dangers and the degree in which a company is leveraged, or how much debt it carries. We can also, as an investor, we would want to know if a company one is considering to invest in is in danger of not being able to meet its payment regime. These are aspects that an investor needs to know through all these. And how do we come to know about all these? We come to know about all these through ratio analysis. I told you about liquidity ratios. It is important for me to be repeating all this because these are now interesting factors related to investment analysis. Remember, we're talking about investment analysis, and this is an integral part of investment analysis. So, liquidity ratio was talked about in the previous lectures. And the liquidity ratios are all about the measuring of a company's ability to cover its short-term obligations. One of the representatives of liquidity ratios is the current ratio. And a current ratio measures a firm's ability to find out the ability to pay off current obligations. How do we look at it? Through a ratio or an equation. Simply by dividing current assets by the current liabilities, and we reach at a result called the current ratio. A different version of current ratio would be an acid test or a quick ratio, very similar to the current ratio, except for the fact that it excludes inventory. For the reason it is also known as a more conservative ratio, more factual, more realistic, because inventories have to be sold. So, the equation for an acid test is current assets minus inventories divided by current liabilities. The inventory part is the only difference between the current ratio and a quick ratio, in which we exclude inventories in the quick ratio or the acid test to reach a quicker conclusion in what the situation of the company is. You would also know about the working capital then by simply finding out what the current assets are by looking at whether they exceed current liabilities. So, we would have a positive working capital when current assets exceed current liabilities, and we would get an equation of working capital with having current assets minus current liabilities, and we would have the working capital available to the company for doing its business. that would also be included in liquidity ratios. So we looked at working capital, we looked at quick ratios, and we looked at current ratios as well. Then we need to find out what the leverage position of the company is. And we find out this through leverage ratios, and this tells us how a company has financed its assets. What is the company's capital structure like? Whether it's a fully paid up cash liquid organization or whether it's flooded with debt. So a 100% equity owned company would have a more loyal following than a company awash with debt. But you need to find out how it finances its assets. And how do we get to that? Through the equation where we find that long-term debt is divided by total equity. And we get the leveraged position of a company. But then when talking about profitabilities, we need to talk about profitability ratios. And we measure it as in percentage terms in order to make, or in order to facilitate to make comparisons of a company's financial performance against past years. Then only we will be knowing whether more profit has been made by a company comparative to its previous profitabilities, and also in comparison to the rest of the companies in the sector or the industry. We need always to be knowledgeable about the relative strength of a company in comparison to other companies in the sector. And then we come to the conclusion of gross margin, which is the resulting percentage when gross profit is divided by net sales. And then we get a gross margin. Then we must know about operating margin as well. And as the name applies, it is all about operations of a company in the current year. And it is the resulting ratio when operating income is divided by net sales. Operating margin equation would look like operating income divided by net sales. This ratio measures the quality of a firm's operations, the strength of the operations of the company, how good a company is operating on a year-to-year basis, and whether it's making more operating profits from previous years or not. This you will know through operating margins. So, in operating margins, we would know about operating qualities of a company. Through net margins, we measure the company's profitability of its operational capacities. And it is equal to net profit divided by net sales. So the equation for net margin is net profit divided by the net sales of the company. And that is actually what profits are all about. We're talking about profitability margin. That is why we were talking about operating margins and net margins. We need to understand these ratios if we need to get into a profitable venture. We must try to understand how to read all the balance sheets. Now, when I talked to you about profitability margins, I talked about net margins and I talked to you about operating margins. While doing that, I would once again reiterate the importance of earning per share. Like the price earning ratio, the earning per share is also one of the most important, one of the most significant popular investor-friendly ratio, in which we are able to find out what the company's profitabilities are. And the equation for an earning per share is the profit available to shareholders divided by average common shares outstanding, because all earnings per shares are applicable to the common shares. That is very important. I did also make a remark about leverage ratios by talking about interest coverage, which is the times interest earned. And I talked about earnings before interest and taxes and interest expenses. The ratio for interest coverage is earnings before interest and taxes divided by interest expense. would give you a picture of interest coverage of a company by looking at this particular leverage ratio. We would know how many times interest payments could be made when the firm earnings before interest expenses and taxes are paid. Now we talked about debt. First we talked about interest coverage ratio. Now we talked about debt coverage ratio. In a debt coverage ratio, we talk about operating profits, we talk about the depreciation, and we talked about the amortization. And these three aspects of the balance sheet are divided by interest expense plus current portion of long-term liabilities, amortization, depreciation, and operating profit divided by interest expense plus long-term liabilities current position. And we come to know about the ability of a company to repay its current liabilities. This was about interest coverage ratio and debt coverage ratio as part of the leverage regime. Now, this was profitability ratios, but we didn't talk about investment ratios. Since this is all about investment analysis, we needed to talk about investment ratios. In this, we can talk about the dividend per share, a little bit different than earnings per share. Whereas earnings per share are the profitabilities available for distribution to the common stakeholder on the basis of earnings per share, this is what actually is paid out to the shareholder. This is different. Earnings are just earnings. They need not be paid out. But dividend is something that's paid out. So DPS or dividend per share is different from EPS, which is earnings per share. So dividend per share is actually the profit paid out to the shareholders per share. Earnings per share was the actual profit on the shareholders' equity, but this works out in equation as the dividends paid to shareholders divided by average common numbers of shares outstanding. The divisor is the same for earnings per share and the dividend per share, except you have earnings in the first case, you have dividends in this case. Now, the investor is actually more keen of what it's going to get as return to supplement his original investment plan. And once again, it was all about capital appreciation, supplementing your investments and supplementing your income, plus the excitement of investment. Dividends is what matters to the investor. But it is not the paramount thing as well. Having said that, we definitely be looking at capital gains as well, which is another way of improving on your investments. Now, since I've just mentioned to you about dividend per share, we need to understand what a dividend yield is. What are the harvests that you're going to reap on your investments? What are the fruits of your patience? And once again, we're talking about long-term investments, and dividends come to people who buy and hold on to their investments. This is not something for the day trader. A dividend yield is a financial ratio. It is an investment ratio, a financial ratio that shows how much a company pays out to its stakeholders in form of dividends. So, the equation works out for the dividend yield as an annual dividend divided by current market share price. So a dividend yield has to be a good number, a number that should be very attractive for people who would otherwise want to invest into a fixed return regime. When we're talking about dividends, you must try to find out investment vehicles and opportunities that are better than fixed income regimes And obviously, we're looking at dividend yields which are greater than the inflation rate, greater than the best fixed income. Just this can be revealed through the dividend yield potential of your investments. So this is equally important to understand, which is different from the earning per share, because that, remember, I told you was on the par value. This is realistic. This is on the market value of the share, because you got to be paying more for a company that's paying you more. We're talking about companies that are giving you regular income. Now, for sure, you don't expect these things to come in cheap. The dividend yields are looked at through a comparison to the market and actual price of a share. Obviously, once again, I refer to the price-earning ratio. This again is an investment ratio. This again is a very key element in determining things with comparison with the dividend yields as well. And I once again would want to tell you, P/E ratio is all about the current market price. The dividend yield would also use the current market share price. Only in this, we use the earning per share as a divisor to find out what the P/E ratios is. Now, price-earning ratios show how much investors are willing to pay for every rupee earned by the company. And higher the figure, more optimistic the investors are about the company, because they feel that there is a potential for growth in the company. There is a potential for the company to make more money in future. That's why you'll have a higher P/E ratio or a price-earning ratio. Now, it doesn't necessarily once again mean that a lower P/E ratio is going to be a bad investment. The only difference is that you have a better, higher double-digit P/E ratio. The optimism of an investor is there in investing into the company. So dividend yields, earning per shares, and price-earning ratios will make the real crux of your investment decision. And once again, we're talking about these ratios in comparison to other companies that we can look at where we need to invest in, because we're going to have A, B, C companies and we're going to have X, Y, Z companies. We need to look at the entire portfolio or the entire basket before we decide what egg is going to be the best or which hen is going to lay the most golden eggs. We need to understand that these comparative studies have to be carried out to be able to find out the real investment opportunity available. ये सारी मैंने आपसे बातें की रेशियो एनालिसिस की, क्योंकि रेशियोज के ऊपर ही हम डिस्कशंस कर रहे थे पिछले लेक्चर में भी और कुछ थोड़ा सा इसमें भी, कैसे हम एक अच्छे इन्वेस्टमेंट डिसीजन तक पहुंचते हैं. तो जब हम मार्केट का एनालिसिस कर रहे हैं, जब हम इकोनॉमी का एनालिसिस कर रहे हैं और एक इंडस्ट्री का एनालिसिस कर रहे हैं और कंपनी का एनालिसिस कर रहे हैं, तो हमने जनरली मैक्रो लेवल पे मार्केट को भी देखना है. तो बात फिर वहीं पे आ जाएगी EIC पे. ये आप अपने दिमाग में बिठा लें कि EIC के बगैर आप किसी भी कंपनी को डिसाइड नहीं कर सकते. तो वंस अगेन द इकोनॉमी, द इंडस्ट्री एंड द स्टॉक और द कंपनी. So we analyze the company. Before that, we analyze the economy as a whole, and then we analyze the stock market as a whole, and then we analyze the industry as a whole, and then only we talk about an individual company. We talk about like a pyramid and finding out what's best at the apex, with the economy at the bottom and the company at the top. But we need to understand economic factors that affect stock prices initially by using valuation models applied to the overall market and consider how to forecast market changes. Now, stock market's likely direction is of extreme importance to investors. And we cannot ignore, we should look at the global perspective because of its linkages to the local environment. Because we are part of the world, because we are part of the globe, part of the continent, whatever is happening globally, because this is all about globalization. This is about business without frontiers. This is business with information, filtering it to you at breakneck speed. Whatever is happening in your neighboring countries, whatever is happening in your region, whatever is happening in the continent, and then whatever is happening in the universe is going to be of paramount significance to be able to link it to your local companies and local market behaviors. You're not an island. You need to find out what's happening around the world, to find its trickle-down effect, its domino effect on the market. We need to look at all the bigger companies, we look at the bigger market. So, obviously, there is a direct relationship between the economy and the stock market. They can't go in opposite directions, they will go together. The stock market has to go with the trend of the economy is going up. Obviously, that's where the stock market will go. Now, if it's going downhill, the stock market will go south as well. It travels with the economy. So, there is a direct relationship between the two. And then we have the economic business cycle, in which we must understand what the recurring patterns are of the aggregate economic expansion and contraction. All business cycles expand and contract, but we must look at the recurring pattern. So, all cycles have peaks and troughs, peaks and troughs. This is a common framework. So, you'll have peaks in economies, and then you'll have valleys in economies with the troughs at the bottom, peaks at the top, and a valley in between. And that's how business cycles move. They can't be static. The company keep going straight up, the company keep coming down. They have to move in cycles and can only be neatly categorized by the length and turning points in hindsight. Now, if we are able to identify cycles, the business cycles, the economic cycles, the common stock variable cycles, we will be able to ride with the trend. So, if we are having a depression in the economy, we'll have a depression in the stock market and we'll have a depression in our investments. But on the other hand, if the market is going well, we can think about the economy going on as well. And that is where we talk about the stock market being a barometer of the economy, an indicator about the health of the economy. And that is where we get all these ideas about capital markets, telling you about health of a company. Now, when we're talking about business cycles, economic research, Statistical Bureau research, these all the economic surveys, these monitor economic indicators. They talk about consumer price indices, they talk about kitchen prices, they talk about general inflation, they talk about GDPs and GNPs, they talk about national savings, they talk about earnings, they talk about foreign direct investments, they talk about foreign reserves as well. So these dates, business cycles whenever possible, and we must have a look at these figures and these researches. All these economic indicators help us make decisions. These composite indices of general economic activity help us make good decisions. These are a series of leading, coincident and lagging indicators of economic activity to assess the status of the business cycle. So if you have leading indicators, we're talking about economies being healthy. If we have lagging indicators of economic activity, we're talking about a depressing stock market. Economic indicators, economic surveys, statistics, results, quarterly results, half-yearly results, and annual results 5-year plans, monetary policies, fiscal policies will be the blend of all macro information flowing in for us to dwell upon and invest in stock markets. These business cycles will tell us whether it's a good time to invest into the market or a good time to get out of the markets, because it's all about timings, when to enter into a stock market and when to get out of the stock market. So, stock markets reflect the economy. Stock markets lead the economy. Historically speaking, the stocks are the most sensitive indicators of the economy. Stock markets consistently turn before the economy does. It has the ability to perceive, it has the ability to preempt, it has the intuition power, it has the ability or the sixth sense to feel what's happening or will happen in future. How reliable is the relationship? How reliable is it? The ability of the market to predict recoveries is much better than its ability to predict recessions. So, the stock market is a good indicator of a business economic cycle going up than it is of an economic cycle on its last leg and coming down. So, stock markets give you a better insight when the economy is on the up, but maybe not as well in its ability to read when the party is over. These stock prices, these capital markets are able to lead a rally in relationship to the economy by having the ability to preempt, by having the ability to sniff out where the market is heading. Now, business cycles, like economic cycles, obviously have something in common, because businesses will ride the tide of the economy. You'll have tremendous economic activity, and obviously you'll have tremendous business activity only if the market is going to be able to sense a good, strong economic revival. The stock market will be in a position to use this economic upward trend to its own advantage by being able to give you a good upward direction. We also must look at the macroeconomic forecasts of the economy. We have talked about ratios, we have talked about companies, but these come before we can talk about the macroeconomic activities. How good are available forecasts? What quality research is available for us to dwell upon or depend upon or rely upon to make investment decisions? But remember, some of the more prominent forecasters have similar predictions and differences in accuracy. These are very small, and investors as a whole can use any such forecast. But then the question arises that does monetary activity initiated by center forecast economic activity? Does monetary activity initiated by the central bank, the state bank, forecast economic activity? Changes due to shifts in supply or demand or actions of the state bank are important. We're talking about monetary policies. We're talking about economic policies. Policies determined by the center and policies governed by the state bank. That's what fiscal policies and monetary policies is all about. All decisions taken by the Federation have to be taken ahead by the central bank, and whatever positive or negative decisions are made by the institution have an impact on the capital markets. So, investors can use any such forecast talk about controlling inflation or talk about rising discount rates or interest rates. You can also talk about reading curves or yield curves to be more specific. They show relationship between market yields and time to maturity. That's what relationship is between the market and the time to maturity, and that's what you get from yield curves. Holding all other characteristics like credit risk constant, we are able to look at yield curves and take advantage of whatever they're telling us. Obviously, curves can be sloping upwards or curves can be sloping downwards. So upward sloping and steepening curves implies accelerated economic activity. An upward sloping steepening curve will tell you about a positive accelerating economic activity. And we take advantage of that. A flat structure implies a slowing economy, and an inverted curve may imply a recession. So, actions by the center and expectations are important. So, a curve going steeply upwards is positive, and then maybe slowing down will show you a recession in the economy, and then slowing down and going down will show you a recession in the economy. So these yield curves also tell you a lot about the general health of the macroeconomic conditions of the economy. Once again, we need not just look at the finer details. We need to have the ability to look at a bigger canvas. The canvas tells you what the picture is all about, and then only can we discuss things in detail when investing in the stock market. So, these curves, these peaks and troughs and valleys, these recessionary indicators, these advancing indicators, all have something to tell us about, from which we can take advantage as investors. You take advantage while looking at the macro indicators, because you need to be able to understand all this. Now, all the markets are measured by index or averages. Most indices are designed for particular market segments, or we can talk about indices in detail when we talk on the topic of market indices. But generally speaking, there are a number of indices one can look at, and there are variations of indices. One of the most popular market index in the world is the DJIA. The DJIA stands for the Dow Jones Industrial Average, a US-based, internationally acclaimed, internationally recognized, internationally followed, internationally believed trendsetter is the DJIA, which is the abbreviation for the Dow Jones Industrial Average. We also have the S&P 500 Composite Stock Index as an international trend-setting indicator of where the stock of the world are going. And S&P would stand for Standards and Poor, and the 500 would reflect the companies that are into the index. These Dow Jones Industrial Average and S&P 500 Composite Stock Index is favored by most institutional investors and international money managers. They tell you where the world's stock market is heading. They tell you where the money is going, where the smart money is coming into the indices or getting out of the index. We need to follow and understand and study where smart money is going in or coming out and when it is doing that. Because soon we'll see a domino effect or a spillover effect or a ripple effect in our own local environment as well. Now, What are the advantages of all these market measures? And why do we need to measure all this? Once again, unless you're able to evaluate where the market is heading, and we do it in numbers, you must know we're having positive indicators on the market going up or when the market is going down, that we can only go and know through set number of patterns into the market index. Now, one of the uses of a market measure is that it shows how stocks in general are doing at any given time. What does it all mean? It gives you a feel of the market, how the market is behaving or reacting. It gives you a feel of the market, whether it's healthy, whether it's weak, whether it's bullish, whether it's bearish, whether it's up, or whether it's down. You feel the market through market indices. They show where in the cycle the market is and sheds light onto the future. That's what use is of a market index. It aids investors in evaluating the downside as well. It helps judge overall performance of the market, and it's used to calculate the best methodologies in investments, because we talk about investment in relative terms. We talk about intrinsic values, but we need to compare that intrinsic value with some benchmark. So, a market index is a benchmark of the market. The market index is a benchmark of the market. The market itself is a benchmark of the economy. And that's why we find out all these relative to one another. So, the stock market is expected to be reflective of the economy of a country, and the index is reflective of the health of the market. And a company can be compared with the reflections of the market index. So the market index basically is a basket of different shares, depending on what sort of index you have created. But the question remains that it is the indicator of the market. But what are the determinants of the stock prices? Who determines prices? Who decides the market prices? Who decides a particular stock price? Who decides whether the price has to be up or down? So, we need to understand the determinants of the stock price. We also need to understand the exogenous or predetermined variables. We also need to understand the potential output of economy. We also need to understand the productivity, the resources, the investment opportunities available. Now, when we know about the investment opportunities available, the resources and the productivity, we'll be able to understand what the determinants of the stock prices are. Obviously, we need to know what corporate taxes are. What are the companies going to be paying in form of taxes, and what is going to be left behind? So we could be talking about earnings before interest and taxes, and we could talk about profits after taxes and income before taxes. We could also talk about government spendings, whether they're being spent on non-development projects, or they're being spent on development projects, or they're being spent on debt financing, or they're being spent on interest to be paid. These are all determinants of stock prices. Now, all affecting total aggregate spendings, which together matter when tax rates are determined. These affect corporate earnings. Obviously, all corporate entities have to pay taxes until and unless it's been decided that these companies are exempt from paying taxes. Our focus would be what is left with the company after having paid out all the corporate taxes. So, total aggregate spending together with the economy's potential, output, past changes in prices, and these determined current price changes in the price level. Now, this is what we have been talking about as the determinants of stock prices. We shall not forget to remember that the stock market is all about demand and supply. Actually, it's the demand and supply that determines stock prices. Of course, all this I've told you about government spendings, about taxes, about corporate taxes, but we cannot forget all about supply and demand. If you find out there is a great demand of a particular share or a number of shares, we'll find out stock prices rising. On the other hand, you have a great supply side of shares, you'll find out prices coming down. So the bottom line is, whatever we might say, it boils down to demand and supply. Greater number of buyers will see stock prices climbing up, greater number of sellers will see stock prices stepping down. So these are also determinants of stock prices. And nobody but market forces are in a position to determine stock prices. Of course, corporate earnings and expected inflations affect expected real earnings of a company. Interest rates and required returns also affect by the expected inflation. So required rate of returns and inflations plays an important part in investment decisions and prices moving up or down, and then stock prices are obviously the bottom line affected by earnings and tax rates. But if the economy is prospering, earnings and stock prices will be expected to rise. Remember, we said the capital market is reflective of the economy. If we have a healthy economy, we'll have a healthy market. If we have a healthy market, we'll have healthy stock prices. And that goes without saying, if we have a weak economy, we'll have a weaker market and weaker stock prices. So they go together. Economies and capital markets are friends. So we need to trade with the trend and make the trend our friend. That was all about the determinants of stock prices. We talked a lot about the investment ratios. This time we were good enough in talking about the general market macro indicators that we have to look at as a bigger canvas of things envisaging our investment decisions, so that we are able to focus down onto one company or a few companies where we can make good investment decisions. Now, while we have been talking about all these things in our previous lecture and this lecture as well, this does not mean that we'll be not talking about these things in our next lectures. Now, while we're doing this, I would like to tell you a significant number of lectures has passed, and we must understand that we have got a regime to follow. So these determinants of interest rates also affect investor expectations in future. Now, like determinants of stock prices, we need also to understand that you have a certain responsibility towards your taking this course, and very soon we shall be having midterms coming up, and I'm sure you will be looking at whatever we've studied, and we'll get on along in the future lectures while talking a little bit about previous lectures as well. Thank you.